Hey everyone, welcome back to Corporate Decoder, the place where we dig into those corporate filings so you don't have to. Today we're cracking open the shareholder report from Parnassus Funds. And let me tell you, this report is more exciting than finding a socially responsible investment that actually delivers returns. Just kidding. But seriously, we're going to simplify what it all means. This is basically Parnassus telling the SEC, hey, we sent this report to our investors, which they have to do by law, just in case you were wondering. We are looking at reports from the Parnassus Core Equity Fund, the Parnassus Fixed Income Fund, and some of the brand new ETFs or exchange-traded funds that they just started, like the Core Select and Value Select ETFs, all for the year ending December. First up is the Parnassus Core Equity Fund, and it basically aims to deliver value. They are concentrating on about 40 US large-cap stocks, focusing on companies that are high quality with increasingly relevant products and services, durable competitive advantages, strong management teams, and sustainable business practices, which is Parnassus bread and butter. So how much did it cost to invest in this fund for the year? Well, for every $10,000 you had invested in the investor shares, it cost you about $89. Now, the institutional shares, which are generally for bigger investors, only cost $67. The Parnassus Core Equity Fund returned 18.52%, which sounds pretty good, until you realize that the S&P 500 index did even better, at 25.02%. This means they actually underperformed, and they tell us the main issue here was stock selection, particularly in financials and communication services. Not having enough exposure in the energy sector and not enough in consumer discretionary helped though, so a mixed bag. Now, if you had invested $10,000 in this fund 10 years ago, it would be worth about $31,104 now, and they show you a chart comparing that to the S&P 500 index, and it trails the S&P 500 in that time. The legal team wants me to remind you that past performance does not predict future returns, and it's really important that I do so here it is. Digging into some key stats, this fund has a whopping $29 billion in total net assets. They only hold 40 different stocks, that's pretty concentrated, and their portfolio turnover rate is about 34%, which means they trade about a third of their holdings every year. They paid over $168 million in advisory fees, so it's pretty serious. Looking at average annual returns, over the last year, the fund returned 18.52%, which was less than the S&P 500, which returned 25.02%, and the same is true over a 5-year and 10-year look. So what's under the hood? The biggest sector is information technology, making up almost 30% of the fund. After that, financials at almost 16%, and then healthcare and industrials at about 11 to 12% each. Their top 10 holdings include names you know like Microsoft, Amazon, Nvidia, Alphabet, which is Google, Deere, Waste Management, MasterCard, Realty Income, Broadcom, and Intercontinental Exchange. Now let's switch gears to the Parnassus Fixed Income Fund. This is your bond fund, folks, focusing on corporate bonds, mortgage-backed securities, and US Treasuries. It also keeps a decent chunk invested in green and sustainable bonds, in keeping with Parnassus values. The cost to invest in the fixed income fund is a lot cheaper at just $59 per $10,000 investment, and the institutional shares even less at about $39 per $10,000. The fund returned 1.92%, which beat the Bloomberg US Aggregate Bond Index's 1.25% return. So unlike the Core Equity Fund, this actually outperformed. Looking at average annual returns, it did okay over the year at 1.92%, but is actually negative 0.30% over 5 years, and only 1.28% over 10. These are the investor share returns, which are just negligibly different from the institutional share returns. Looking at the sector breakdown, corporate bonds make up the biggest chunk, about 45%, then US Treasury bonds at 25%, and US government agency bonds at around 12.5%. Their top corporate bond holdings are companies like Truist Financial, McCormick & Co., Alexandria Real Estate, and Southwest Airlines. Next, we have the brand new ETFs, the Core Select and Value Select ETFs, so there is only a short amount of performance data available. The Core Select ETF invests selectively in about 25 US large-cap equity securities. What was the cost? It was only $3, and the expense ratio was 0.58%. Because it launched in December, there is only data from launch on December 11 through the end of the year, and in that very short time, it returned negative 4.11%, while the S&P 500 did negative 3.26%, so it got off to a rough start. The greatest sector exposures include materials, industrials, and financials, with the largest underweights in the consumer staples, energy, and communication services sectors. The most significant weights included materials, industrials, and financials, with underweights in consumer staples, energy, and communication services. They also say they are taking a balanced approach to the portfolio given the current market environment, neither overly offensive nor defensive. They barely had any assets at about $2.8 million and the portfolio turnover was 0%, so it held all of its stuff the entire time. Sector allocation, the largest one is information technology at almost 32%, with financials at about 16%. What are their top 10 holdings? You guessed it, Microsoft, Amazon, Alphabet, Nvidia, Apple, Waste Management, Danaher, Realty Income, Deere, and Intercontinental Exchange. Now for the final ETF, the Value Select ETF, which follows a value strategy. What's the cost of this ETF? About $3 per $10,000 invested, with an expense ratio of 0.59%. How did it perform? From its launch in December, the Value Select ETF lost 4.72%, which was worse than the Russell 1000 Value Index, which lost 3.82%, so again, a tough start. The greatest holdings were in healthcare, communication services, and information technology, and the largest underweights were in the financials, energy, and consumer staples sectors. It had about $1.2 million in assets, with zero turnover in the portfolio. The holdings were pretty different, with healthcare making up 23.5% of the portfolio, with information technology at about 16%. It had top holdings like Pfizer, S&P Global, Verizon, and United Health Group. Okay, so let's move away from investment performance to something a little more behind the scenes. The funds have a code of ethics that's been in place for a while, and there were no amendments to this code over the last year. Next is the Audit Committee Financial Expert. Basically, it's someone on their board, Kay Yun, who is really good with numbers, with lots of years of experience in private equity, investment banking, and technology, and they basically trust her to oversee the accounting. Now comes fees. Audit fees for the Parnassus funds for the years 2023 and 2024 were $297,550 and $95,000 respectively, and the Parnassus Income Fund's fiscal year ended in those periods were $234,950 and $78,000 respectively. Then there's tax fees. They paid about $33,955 and $15,412 respectively in 2023 and 2024. They didn't pay any fees that aren't specifically related to audit and tax. So before the auditors do anything, the audit committee has to pre-approve it. It is pretty standard to do so. They confirm they have a separate audit committee with all the independent trustees. I'm jumping here to item 7. It's essentially just a pointer to the financial statements, which, as you know, we covered earlier in the video. The officers said, yeah, we checked the boxes, everything's good here, standard language here, and that's it, we've digested a whole year of Parnassus shareholder reports. So what's my take on all of this? On one hand, their core equity fund actually underperformed the S&P 500. On the other hand, their fixed income fund is beating its benchmark, and while the numbers are small, it is impressive considering they're sticking to their ESG principles. They also have a ton of assets under management in some of their older funds. As for the new ETFs, it's far too early to judge if they will take off or not. Their commitment to social and environmental responsibility is still a major differentiator. This can create great goodwill and attract investors who value purpose alongside profit, but it can also limit their investment universe and sometimes create performance concerns. Overall, Parnassus seems to be navigating a complex landscape. Their expense ratios are a bit high compared to more traditional ETFs, but it is hard to tell if that's justified by their selection process. In conclusion, it seems like Parnassus is trying to balance their values-based investing with delivering returns in a tough market. Whether they can continue to do so remains to be seen, but at the very least, they are holding themselves accountable and trying to be transparent about it. Thanks for watching. If you want to see more corporate filings decoded, please subscribe, like, and comment below. Let me know what company you want me to take a look at next time.